Hey, this is Phil Ratcliffe with Rebel Financial, live streaming to you from our conference room in our Gahanna, Ohio office. If you're tuning in to us live, thank you so much for joining us again. Apologize, we're a couple minutes late. It's always fun trying to get all the technology to work for these live streams. So we're joined here today with Tony Jones. So he is kind of our resident 401k and pension specialist. He's been with us. This is almost the 1 year anniversary. I've known Tony for over a decade, and he's actually, the reason why I know him is because he helped us back when I worked for my previous company with our 401ks, and now he works directly with us. So Tony, thanks so much for being here with us today.
Thanks for having me, Phil.
Awesome. So as we start talking about 401ks, the main thing, this is going to be a little bit more of a dialogue. It's not as much of an interview because me and Tony work together, helping businesses with 401ks. So I'll probably ask questions in queue, but we'll probably both talk a little bit about, our combined knowledge. But really, just, kind of for our viewers, when we're talking about like the type of 401ks that we deal with that are smaller and medium-sized businesses, what are we talking about?
In terms of who we work with, the smallest company out there, one person, up to, a one-person company won't have any assets when they're just starting out, but maybe as big as a plan that's towards, and a little over $10 million and possibly up to 300 people.
Yeah.
And so not tiny, around here, that's most companies.
Sure, absolutely. So, when we think about that, we're not thinking about like the big plan that Nationwide's got for its employees or CODA or, Ohio State.
We are not geared for that. We are geared for the smaller ones. So.
Yeah. So when we think about, your last like 12 years of experience, there's been a lot of change in this marketplace, a lot more than there has been in the past. So maybe just give us an idea of how things have changed and some of the changes that you've seen over that time period.
I would say, the biggest change, and it all stems from oversight of 401ks. When I first started in this industry, I was helping advisors to work on 401ks, and you'd be appalled at some of the numbers that advisors could and would charge on 401ks.
Sure.
It would totally defeat any kind of returns that were out there in the market. So aside from the returns, a lot of the service, there was a lot of issue with that. Advisors would sell a 401k and never show up again to help the participants, which is probably, their biggest need in a 401k. Participants do much better with advisors.
Sure, and that still happens a lot.
It still happens a lot. Yeah, it's just, you're asking the change. It's come a long way. The oversight, it's under a microscope now. It was the Wild West before, and it's not that now.
Got you.
So I would say that's the biggest change.
That's the biggest change. So I think, me and you talk a lot, and I think one of the challenges that we face as well too is in the smaller market, it tends to be very controlled by, say one person that owns the company or a partnership or what. So unless we're talking about nonprofits, then it's a board, which is a totally different dynamic. But, tell us a little bit of some of the challenges with that as well too.
Well, when you work with just one person, there's a couple issues. One is often, if they have some knowledge of investing, they have very strong opinions on how things should be done, as opposed to a committee where you really have a number of heads coming in. So that's one. Often with smaller plans too, the advisor may not be a 401k advisor, and that advisor may have been put on the plan or had won the business because they know the owner and they're golfing buddies. And while that may work out okay personally for the owner of that business, it can be detrimental to the participants in the plan and the overall strength and health of the plan.
Sure.
So, when it comes to the smaller plans, that's really...
it could absolutely be a benefit in terms of like being very executive. So if someone was to say, I'm really going to take almost like a bigger company request for proposal and see, all right, here's the best thing for our plan, for me, for the participants, I'm going to implement it. They could do it super fast, and that could be awesome.
Yeah, you're right. If they really want to make the best plan and put that forward and go to those efforts, then absolutely. That is the advantage of the smaller companies. When somebody is looking to build the best plan possible, it's a lot easier to do it with a small company.
So when we talk about that, again, like we said, there are a lot of subjective things where we say, what is the best plan? So, like you had mentioned earlier, there's been a lot of pressure on fees. So, I mean, are the best plans just the ones that have the bare minimum fees and are just the cheapest ones out there? Because it seems like that's where the market's headed.
Yeah, I would say yes and no. My yes would be all things being equal, that's true. There's a number of uh, salient fees that you can see and you could compare to other companies. The biggest issue, I think, in 401ks, it can be the biggest issue, is participants' behavior and lack of education with investing.
Mm-hmm.
And an advisor can really add a lot of benefits to that. If somebody is not seeking financial help in a 401k, the blunders they make on themselves will be the most costly and the biggest cost of the plan.
Mm-hmm.
And it's really not quantifiable. It is, we know the numbers as a whole in the industry. Participants on average can lose up to 7% compared to what the benchmarks
Per
are.
year.
Per year. Right. So you can multiply that by years and it's a losing proposition.
And then that's just performance. Like, how much could somebody kind of being a coach or a partner get them to contribute more, or
yeah.
get them to increase over time? Or if they had a hardship and turned off, to remind them, you need to turn this back on and start saving again, or to help them brainstorm about how they could solve a financial problem without taking a loan or a hardship withdrawal and paying tax penalties and whatever the case.
Right.
You know?
I think these are the tip of the iceberg type things.
Yeah.
But so I think too often when we talk about fees, it was very important for them to come down. But at times it gets to the point where, in spite of the best intentions, often they'll weed out an advisor and the help of an advisor. And then the problem is the advisor has to be a good 401k advisor to want to help those participants if you're going to pay for that. So I look at these plans and I say two things. If you really don't see the benefit of an advisor, which is too bad, right, then I would say get the cheapest plan you can. Because, but if you take a look at the advisor and go a little deeper, you would see how much value they can bring. And they could really help participants a lot. And not just in a 401k. They may help them in some simple things outside of 401k too.
Sure, sure. So when we talk about help, I think I see this a lot of advertisement from bigger investment companies, say like Fidelity or Vanguard or what, so that do provide some of the most cost-effective plans out there, but they'll say, we do participant education, and they provide these PowerPoint slides or online tools or what, so, I mean, obviously, I haven't totally seen the research from this, but what are your thoughts on like how effective that is going to be to like influence or change that participant's mind to do the right thing?
It's pretty negligent. Those that already have some knowledge and are already seeking the answers, it's great that now they have an extra tool, but they're probably going to find those answers elsewhere. It's a vast majority of participants in a 401k that don't take that initial step on their own anyway, so they're not even going to use the education material. And that's another great point of why an advisor makes great sense on a 401k, because a good advisor can help hold their hands through that process and kind of deliver that education to them if he's working closely with them.
So I think maybe a lot of people have seen, at least in the news or a headline or something, about what the Department of Labor has done in terms of making more companies, or all companies eventually, that are dealing with 401ks be fiduciaries. So tell us a little bit more about that and what your thoughts are on that.
So advisors in general are kind of classified in two ways. They can declare themselves and make themselves a fiduciary. Once you do that, you have to put the interest of the client ahead of your own. Right? It seems like everybody in this business should be a fiduciary, but they're not always, and there are some good reasons. If they are not a fiduciary, then what they have to do is make sure the product or how they work with the client is suitable for the client. So not necessarily in the client's best interest, it just has to be suitable. So there can be a conflict of interest. So before the Department of Labor made these rules this April of 2016, there was no distinction between retirement plans and individual planning. But basically what it did was make a big distinction. If any advisor is working in a retirement plan, or a retirement account for that matter, IRAs and such, They are
That
now,
came from a
that came from
a
one,
401k.
right? That stemmed from a retirement plan. They now are working in the capacity of a fiduciary automatically. And so what we're going to see probably, hopefully, those advisors that weren't necessarily putting their clients in first will probably be more reluctant to jump into retirement plans and 401ks and such.
Sure.
And so we're going to really see a consolidation, I think. It could happen, maybe it won't, but a consolidation of advisors, and there'll be more experts on 401ks, advising on 401ks,
Sure.
not just your average Joe
I
advisor.
remember reading an article not too long ago where they did a study of asking regular investors, do you think your advisor is a fiduciary? And it was upwards of like 90% answered yes, but the reality is only like 10%.
Right.
So it's almost like a backwards from what people think, because we think that this person that's telling me what I should do with my retirement or my life should be looking out for my best interests. So that's the way it probably is.
Should be, right?
And it's not.
But they're not.
Yeah.
They don't have to.
Yeah.
And there's a lot of incentives at times. You know, I believe most advisors are good-hearted and are going to try to do the right thing, but there's a lot of incentives that may pull them off that track a little bit.
Sure.
You may have 2 or 3 products that are pretty comparable, but if one is more lucrative for an advisor, sometimes they may be drawn to that one.
You know, and it's interesting. I mean, we as a company are a big adopter of technology. I love technology, but I think one of the things that is being missed by some of the companies like Betterment and Vanguard and some of these, even Schwab and TD Ameritrade that are trying to put out like robo solutions and saying, if everybody would just do what the computer says, then we'd all have good outcomes. But we're not computers, and we're generally not going to listen to a computer. I mean, if we want to get a little bit sci-fi, maybe eventually we will.
Right.
There's something called the Turing test, basically, where what that means is that when a computer develops enough to where a human being can't tell the difference between it and another human being, I think at that point, then our artificial intelligence might be able to change behavior and help people. But right now, I think, when we think about an advisor, and we say an advisor, like generally, like it could be any advisor, but I think you got to have 3 things. I mean, and you've touched upon all of them. Is like, first of all, I think at a bare minimum, they need to be a fiduciary. So people need to be able to trust that who's telling them what they should do is in their best interest. Second of all, I think, and this is second and third, I think they gotta like respect and admire that person. Not too much like the president or something, but like this person is good at what they do.
Or maybe
I
more so than the president.
Yeah, and well, a lot of people on both sides they're going to agree with that statement.
Right.
But yeah, to where they say, I trust this person. They're specialized in what they do here. I'm going to follow that advice, and they know me and they care about me. And even if a computer could generate a similar piece of advice, which a lot of times it can't because it's just not complex enough to like take in the intricacies of someone's life, it's not going to make a difference. And I think that's what you said. Like, these are nice tools for people that already kind of know, but otherwise, people need that almost relationship, even if it's just minimalistic to where they know your name and face and you shook their hand. Even that short-term interaction can make the difference to where they say, I'm going to save 2% more. Or they're right, I should do Roth instead of pre-tax. Or, you know what, I'm not going to take that hardship withdrawal, I can do without that. And then not having to pay that 20% tax and 10% tax penalty, and we compound it for 15 years later, they're going to have so much more.
Right.
And so I think that's what we're trying to get at. Because you look at, we're going to show you a couple tools before we before we finish up here so that you guys can see them. But we're all about, the movements that are going on in the industry to promote more fiduciary participation by the companies and the advisors. I think that's what we should have been doing all along. We're also about using technology to be more efficient and lower costs and what so. And we're all about trying to lower costs in general for clients. But I think, like most of us in our lives have learned somehow that in most areas we don't want to be cheap. Yes, you want to get a good value, you need to get a good price, but I think a lot of the 401k industry is very much teetering on that, especially with a lot of the lawsuits.
They're being scared into it.
Yes, to say, I've just got to get the cheapest stuff.
Right.
And then my employees can't sue me. Like, it's like some battle between the participants and the employer, when really it should be a partnership of saying, how can we help people succeed more? And so,
And often when we take over a plan and the plan administrator has had experience with a not so good advisor, they appreciate us that much more. But when you have a plan that they've just focused on the cost or it's newer, they don't necessarily appreciate that. There's nothing better than working with a plan administrator who appreciates what an advisor can do for a plan.
so we're just going to show you a couple things real fast. So this is our website, good401k.com, as opposed to our primary website, which is Rebel Financial, which is everything. But if you're just interested in 401k, it's pretty cool. We've got a lot of good information. It's very transparent if you want to read about us. But one of the cool things that we do, even if you don't want us to manage your plan or what so, is we do these plan analyses. So you can click to see kind of a sample plan analysis right here. And as you scroll down through it, we'll take the information from the last few years of either you, probably your TPA, your accountant type person, filing your stuff with the government. We take this information and basically benchmark your plan to say, how well is your plan doing versus your peers? So your peers are plans that are about the same size. And then how well is your plan doing compared to your entire industry, regardless of the size of the plan? And so then we can see, what was the actual total return? We're not looking at the funds or anything. We're just saying how much was there at the beginning of the period, how much was there at the end of the period, accounting for how many contributions went in there. So it's like a real rate of return. And so then you can see that. And then we give you a 5-year average so you can see, a little bit longer time frame. And then participation rate. So like how many of your people are participating in the plan versus peers and industry. And the goal should be to get more people in there so that they're going to be successful. And then utilization, how much are people saving and how is that different? And then we can even benchmark in terms of saying, how much are you matching or putting in or profit sharing compared to your peers? So like if you're trying to recruit or have or retain the best people, well then obviously we want to have good salaries, but we got to have good benefits. And this is probably one of the most important, even though people neglect it most of the time. So there's lots of great information in this. We do this for free to help people figure out where their plans are. And then, if there is a problem, at least you know somebody that can help you fix it. Another one of the tools that we use, and we invest a lot in different tools or what so this is just a sample for a fake company because we don't want to put anybody's real stuff up there. But we actually produce our own 408B2s for our plans so that we get the complete fee thing. Because it's interesting, the Department of Labor says that everybody has to do this now. And a lot of the custodians are putting these out there. But me and Tony are finding when we talk with people, it's missing lots of stuff.
Right.
And so like we have to call them, get them to call and figure it out when they're just supposed to get this. So we do this to be very transparent so that you can see exactly, and then we make sure that we put everything from everybody, from the TPA, the record keeper, the custodian, what we charge, and then you can see that broken down, and then we put it in different formats so that you can see it in different ways, who pays it, the participant, and then we produce these on a quarterly basis so that you can actually see it, and it's very transparent. We've had a couple people say, oh, it seems so expensive, and we're actually like 30% less than what they were paying before, but they just didn't know what they were even paying. So,
and these technologies, they're becoming necessary to protect yourself, to show the Department of Labor that you really do care about your 401k and you're doing the right thing and going through the due diligence.
And then we also do this, since we're a 338 fiduciary to the actual employers as well too, we produce these reports, on a quarterly basis to monitor all the investments in there to make sure that they're trending well versus what the markets are doing. We don't necessarily just pick the cheapest thing. We want to make sure we have the best thing. Now, we do very much lean towards lower cost investment options. A lot of these are just showing you kind of what the standards are doing. And then we get down here and going through our actual funds and how well are they performing? Are they on a watch list? What's their performance versus benchmark or what. So it's pretty complicated. And then we store them. This one's not going to have too much just because it's a sample one. But we show, we have different benchmark based on short-term, mid-term, long-term, and it grades them, and it shows us check marks on whether they're staying above. Like our standard is they need to stay into the top 25%. Otherwise, they're going to be on our watch list. A new tool that we actually hired on top of this is a newer company called eValuator, and with this one, it's kind of similar to that. It's a little bit more GUI interfaced, but then we can see exactly, for the funds that we have and how much we have in them, whether they're doing really good and staying at that top, like or whether they're in our watch list, or whether possibly they need replaced. And then we can change, based on, we can customize this for different plans, but we do, most of the people that hire us depend on us for this. But this allows us also to say, if something's getting down there, let's search for a replacement that is good in the short, medium, and long term. We don't just want to fire somebody, and sell low and buy high.
Right.
We want to make sure that they're good investments. So, these are actually kind of expensive investments that we make. A lot of companies, they're stretching to buy one, and we have like 3, and we're just looking to hire one of our partners to build us another tool to expand our benchmarking capabilities as well too. So Tony, as we kind of close this out, do you have any closing thoughts? When we think about 401ks and what we could do?
No, I think the direction of the industry is going in the right way, but you have to be careful that you just don't scrape the bottom of the barrel in terms of fees, because then you're going to get a value, and if you really want your participants to do well, you need to be cognizant of those things.
Sure.
So.
We don't want to save like a half or 0.3% to cause our participants to underperform by 4.
Correct.
Yeah.
And that's what sometimes happens too much, and with good intentions, that happens. So, I think that's it. One of the things, these reports we talk about, as I said, they're necessary. People should be building their files for the Department of Labor in anticipation of an audit, because it could very well happen. So they're necessary. Your advisor has to be participating more actively in a 401k.
And I think ideally, we don't want to necessarily just build a file for the Department of Labor. We want to do things that are going to build a good plan that they would come in and look and just say, good job.
Right, exactly.
We did it though for participants.
Right. Right.
So we appreciate you joining us for another live stream. I apologize, this one was a little long. If you've got comments or what so, we're starting to build up our viewership. Put them below. I think within the next couple weeks, we'll actually start taking live questions off of Twitter and Facebook. So let us know your thoughts. Post below. We'll answer. We may even do a follow-up email that we post below if somebody has any interesting enough questions. So thanks so much for joining us. Join us next week. We're actually heading off in just a couple hours to go down to the Ohio Chiropractic Convention. So hopefully we'll be able to go down there, meet and help some people, and maybe get an adjustment. So thanks so much, guys.
Thank you.